distribution for Satrix, and I will be your host for this webinar. Joining me online today are Kingsley Williams, Chief Investment Officer at Satrix, and Nico, Katzke, our Head of Portfolio Solutions. Before we get started, I would like to get some of the housekeeping out of the way. We have applied for CPD points, and those attendees that qualify by staying for the duration of the webinar will be contacted directly once the CPD certificates are available. On our platform, you will also find links to download the slides we will be discussing today, and please feel free to use the Q&A functionality to send us your questions. We will either answer them directly or reach out to you following the webinar. So let's jump straight in. Kingsley, 2024 was a good year for Satrix and for indexation more broadly. Can you give us a brief business overview?
Thanks, Ruan. Very happy to, and great to be with everyone today. I'm very pleased to say that Satrix remains at the forefront of indexing and systematically managed investment strategies in South Africa, with our assets under management growing by about 40 billion rand relative to a year ago. Pleasingly, the vast majority of our AUM is from a diverse range of different clients, indicating the trust clients have placed in our business. We've been very busy with our product lineup, which we'll talk about later, while the investment team remains stable and highly efficient at managing the vast array of portfolios, funds, and different vehicle types that we offer clients. Now, on this slide, you can see the growth, which is across all our broad investment capabilities. And in particular, the growth of our AUM offering international exposure has been very pleasing to see, as investors and clients embrace the compelling investment returns and highly effective or highly cost-effective options that we have available tracking global indices. We do not take the trust that clients have placed in our capabilities and our funds lightly, and we constantly challenge ourselves to see how we can innovate and be even better at what we do. An important differentiator is our ability to offer a wide range of vehicle wrappers to suit different client requirements. So ETFs continue to expand the lead they have within our AUM mix, followed closely by unit trusts, both of which can be accessed directly through our Satrix Now platform or through your preferred platform. Satrix Life Pooled Funds, in conjunction with Sanlam, serve our corporate and employee benefit clients, while large clients have the option to contract with us directly via a segregated mandate to manage a portion of a larger portfolio, as many of our institutional clients prefer to do. Satrix is truly a one-stop shop solution, which is able to provide and meet most, if not all, of your investment needs.
Thank you very much, Kingsley. Nico, if we turn our attention to the markets, how did indices perform in 2024? What were some of the themes that you saw play out during an uncertain year, marked by elections and geopolitical posturing?
Yeah, look, Ruan, it was an interesting year. 2024 was very much a year of two halves, or in fact, more accurately, 3 1/4. In September, and this is the slide that we show you now, we still had markets up 25% mostly. And listed property, for example, flying at over 50% year on year, with bonds also scaling mid-20%. All of this was buoyed largely by a surprisingly positive local election outcome. Now, on the next slide, if we forward 1/4, we see the major indices being mostly flat or even negative, in fact, while the Rand pulled back strongly to even erase its full-year gains completely for the year. Now, all of this followed a rather unexpected Trump re-election, or at least, let me rephrase, unexpected in terms of the margin of victory, that caused markets to hold its breath to see how the incoming US administration would shake out. Now, threats of tariffs and the possibility of returning inflation, all of this definitely put the brakes on some asset classes. Now, most notably, for a year that swung between red and green, was the enormous returns earned by local small caps. Bonds also continued to deliver strongly, eclipsing that of the broad equity universe for most of the periods that you see here, which is a really interesting feature of our local bond market. Now, the Rand strengthened post-election, sure, but paid back all of those gains to, in fact, end the year weaker than when it started. Now, on the next slide, and this is something we've shown in the past, but I just want to give you a sense of how, in fact, these dynamics have changed. 2024 was very interesting in that the Rand-placed stocks made a very strong comeback, despite the currency overall weakening for the year. Now, the red distribution that you see in the middle shows that the top Rand plays returned around 29% on average for the year, while that of the Rand hedges returned some 20% on average. Now, this shows us that the post-GNU optimism benefited SA Inc. and small caps beyond just being a currency play. So market optimism around SA has undoubtedly improved and is also part of why we like local nominal bonds. And we'll return to this a bit later. What I want to show you on the next slide is we call this a return funnel for the listed stocks on the all-share exchange. Now, notice how the top performers at the top were virtually all small caps, as you can see by the table on the top left, and almost all industrials. So small cap industrials had a wonderful year, speaking to the improved overall consumer sentiment for South Africans, albeit coming off a very low base. Now, the biggest drag on performance for the local index was indeed resource stocks, as you can see clustered there at the bottom. Now, this is despite gold hitting all-time highs in 2024. So a very interesting year for stock pickers and index trackers alike. A lot of opportunities out there for stock pickers. Now, on the next slide, we look at global indices in Rand terms. And what we see is that it ended the year very strongly for the most part, except for global bonds and global property that were mostly flat or even negative in dollar terms. Now, developed market equities and gold had a particularly strong run in 2024, while China also surprisingly bounced back very strongly following a challenging few years preceding it. Now, EM more broadly underscored that once again it is the perennial bridesmaid, but never quite bride material, with its returns strongly lagging its DM counterparts for all the periods that we show on this slide. Now, we do believe there's some merit in upweighting EM, as there's certainly value to unlock, especially with China and India being well poised to take market share in tech industries more broadly coming in coming years.
Thank you, Nico. So, Kingsley, if you can please give us a sense of the flows that you've seen into active and index funds for the year. Are there any interesting trends that we should take note of?
I think there are a lot of interesting trends that investors would be intrigued and curious to hear about. So hopefully I can unpack those for you now. On the slide, you'll see that the upwards growth in exchange-traded fund adoption continues apace. Now, here we've specifically excluded commodities, actively managed ETFs, and there's been a lot of enthusiasm around the introduction of that vehicle type to our market, as well as bank-issued exchange-traded notes and actively managed certificates. I know there are a lot of acronyms. But from our perspective, it's very encouraging to see this development, as we have seen this take place globally, especially in the US, but increasingly in Europe and other parts of the world, and that this is now happening in South Africa too. At a high level, investors are now recognizing the greater flexibility, the cost advantages, and the more consistent outcomes that exchange-traded funds typically offer client portfolios, which is showing up in where money is flowing. And we're very pleased as well to report that Satrix has been dominant in the ETF space, where in 2024, we received more than 7 out of every 10 rands of net flows into exchange-traded funds. We continue to focus and enhance our ETF range to ensure they are the most compelling offering available in the market. Now, context is critical, and you'll hear me say that a few times. If we look at the entire unit trust space, which is dominated by actively managed funds, flows have largely flatlined over the last 4 years. And if you put that in context, over that same period, cumulative ETF flows quadrupled. And one of the key reasons for that rapid growth in ETFs has been the ability for advisors and discretionary fund managers, DFMs, to access ETFs on traditional platforms such as LISPs. Investors now have increased access to a wider range of exposures and investment strategies, which are only available in ETFs and can seamlessly now hold these alongside their existing unit trust exposures. The ETFs can be allocated to, rebalanced, and switched to and from seamlessly like a unit trust without needing to worry about all the intricacies of trading them on an exchange. The advisor can still earn their fee for advice or portfolio construction alongside the LISP advantages of reporting and having a single consolidated view of all of your investments in one place. Satrix has pioneered this innovation, and we're pleased that most of the lists are now on board. So if your preferred platform doesn't yet offer ETFs, please ask them to reach out to us, and we'll be only too happy to assist. Now, across all ASISA categories, excluding money market and commodity ETFs, we see the adoption of indexation is now just over 10% in our market. And this means that despite the strong flows into index strategies, the South African investor is still highly underinvested in index-based strategies. If we zoom into the local equity categories, including property, the indexation adoption rate is slightly higher at 14.6%. However, any concerns about a passive bubble are certainly unfounded in South Africa, where we significantly lag the indexation adoption rates of Europe and the US. If anything, non-indexed active funds in the light blue or cyan color are in a bubble within South Africa. We'll share more thoughts on this towards or as we go through this webinar. Now, what is quite striking is that the South African investing public seems to have recognized how far behind the curve we are and have over the last 5 years increasingly been allocating to index funds in both unit trust and exchange traded fund form, where last year the net flows, so I must stress these are net flows and not AUM, the net flows split between active as a cohort and indexed as a cohort resulted in almost 9 out of every 10 rands going to lower cost systematic alternative funds, in other words, index-based funds. Suffice to say that it has been an excellent year for indexed investment strategies compared to active. And we're very delighted by the fact that Satrix's share has been growing alongside this increasing move towards indexation and has received more than half of the net flows into index funds last year. So from all of us at Satrix, thank you very much for your continual support.
So, Nico, how should listeners interpret these flow numbers? Why did active managers struggle to gain more market share?
Yeah, that's a great question, Ruan, and one that we hope to provide some context on following what Kingsley was showing in terms of flows. Specifically, we hope to shed some light on why active flows have slowed and why index flows are picking up. You know, it shouldn't be surprising that we believe this is no mere coincidence, right? But rather that we believe it's our market catching up in terms of the value that indexation can bring to a portfolio. So in order for us to understand why active flows have slowed, let's approach the following 4 simple questions that I want to pose to you with some rudimentary empirical analyses that hopefully can explain part of why we're seeing this. So the first question that we want to pose is, how easy is it to find winners? And if so, then we would simply see flows from winners to losers, right? As opposed to flows from losers, for example, and winners to rules-based index solutions, as Kingsley said. So if there's persistence, well, then we shouldn't expect outflows or net outflows from active managers. How easy is it for managers to execute on correct information? Now, if this is indeed easy, then good managers should be able to identify themselves or become identifiable and then execute on good information and turn sound research into actual results. The third question that we want to pose and look at is, how active are active managers in South Africa generally? Now, considering that still around 90% of CIS assets are managed actively, as Kingsley showed, the question is, do managers have an incentive to be bold and risk their assets, right? Or have more incentive to be cautious, particularly considering how much uncertainty there currently is in global markets. Now, the last question that we want to pose is, are index strategies simply a cost reduction exercise? Now, or does it offer value other than simply this low-cost structure? After all, no one wants to be penny-wise, pound-foolish, right? So a cheap alternative may be just that, may just be cheap, but no value. And so we want to tackle that question head-on. So we're going to tackle these 4 questions to help us understand why we're seeing this trend in South Africa and why we believe it's not a fluke. So for the first question, on this slide, we're going to address the first question that we posed was, how consistent are active managers? Or putting it differently, how easy is it to find the winners? Now, we've shown you this graph before, but I think it's such a powerful way to visualize the difficulty in being consistent locally. So what this graph shows you is it represents, all of these represents active managers in the local ASISA general equity category, with the color representing the past 3-year performance. So if you look at any given year column, then the color of a given line is an active manager. The color is given by the past 3 performance. Green implies that a manager was a top performer over the past 3 years, while red implies it was a poor performer. We then stack each line in a given year by that year's performance, just to show, well, if all the greens line up at the top, like you see on the slide, and all the reds are at the bottom, that simply means it's easy to find winners because you just have to look at past performers and, Bob's your uncle. So the correlation also between past 3-year performance and given year performance, that we show at the top of each bar. And if past performance was any indication of current year performance, those would all be 100%. I can imagine, or I suppose you can imagine that this is not the way that reality looks like. In fact, the next slide shows this very clearly. Over the past 20 years, this has looked more like a Christmas tree, right? The correlation between past and current year performance has mostly been random. In fact, we did some analyses that if you had followed the strategy of moving funds from winners to losers every year, in other words, top quartile performers to bottom quartile performers, you would have done far better than had you not done anything or actually moved towards the winners. We take this to mean that replicating past success is incredibly difficult in our local market. And so the notion that finding winners is an easy task actually cannot be further from the truth. Now, despite this, on the next slide, and this is quite interesting, this shows that despite this lack of consistency, we are very consistently seeing flows chase winners. So what this graph shows us is the past 3-year top quartile performers in a given year, that is indicated by the light blue bar, and the bottom quartile performers, that is indicated by the dark blue line for the 3 years preceding each given year. Now, and then we look at that given year's flows, either toward winners or away from losers. And the only exception that we see since 2008, where we've not gone from net inflows going from losers to winners, has been last year, where past winners actually saw most of the outflows. But this is also, incidentally, the year that we first showed this analysis, to be fair. So hopefully the market is realizing the folly of chasing winners. Now, the next question that we pose is, how easy is it to actually execute on good information? So suppose you now have a consistent manager, or you've identified a manager that you believe they are able to replicate their or have a research process that they are able to replicate some consistency. Well, the next question that you have to ask is it actually easy to execute on correct information in our market? Now, this is a key question that is seldomly asked of managers when it comes to implementing their investment views. If you think about manager researchers, oftentimes you want to understand the process and the thinking behind the investment strategy, but very seldomly do we actually ask, okay, but hang on, do you have what's your process in terms of implementation? In other words, when you buy and when you sell. Now, the reality is that even if an active manager's research is correct when it comes to picking a stock, the timing of buying and selling is incredibly important as well. So what this graph shows you, and this is just an illustration, right? So we just took a random stock, Woolworths, and we showed the peak to trough variation of the Woolworths share price in 2024 to make this point. Now, if you bought at the peak or sold in the dip, this could have made all the difference in your investment in Woolworths. So irrespective of your view, on the price of Woolworths, timing of execution mattered greatly. Now, for Woolworths, the price moved in total 23% between peak to trough for the year. Now, if we actually look at all the large caps in our equity universe, this movement of Woolworths is actually quite benign. So the next slide shows us this. Here we show how flat the Woolworths share price actually was for the year compared to other large caps, where the average stock varied 41% between peak to trough throughout the year. Now, clearly, this means that the timing of execution matters a great deal. For some stocks more than others, of course, but on aggregate, it matters massively. Now, the next slide shows a box plot for peak to trough movement since 2015. So 2024 was not this outlier year where stocks, sort of moved a lot peak to trough. In fact, if we look at it since 2015 for large, mid, and small caps on this graph, we notice that it's not uncommon for stocks in our market to swing more than 40% peak to trough in a given year. Now, this means that when you buy and sell matters almost as much as what you buy and sell. Now, this is an often underappreciated and consideration related to execution, where we seldomly interrogate this, as I mentioned earlier. Now, contrast this to the orange bar that you see at the bottom, which shows the average peak to trough deviation of an index tracker. For example, what I show here is just the Satrix. Now, the index value typically oscillates between 10 and 20% peak to trough through the year. Now, what this means is that the timing of entry and exit when using index building blocks matter far less. And this means that executing on asset class positions are not as precarious. So maybe just something to keep in mind that helps explain to us how, in fact, what makes it so difficult to be consistent is that your timing of execution is also always a very important feature as well. Now, we then turn to the third question. And this is, are active managers truly active in South Africa? Now, this is a fascinating graph because it shows the average active share of active managers relative to three common equity benchmarks through time. Now, notice how active share has plunged in recent years. Now, active share is just a measure of, think of it as how active a manager is. If your active share is 0, that simply means you're exactly tracking an index. Between 0 and 20, that we regard as tracking. Between 20 and 40, we call that quasi-tracking. And 40 to 60, that's moderately active. Above 60 is generally what we regard as being active. Now, this graph shows us that the average active share of managers relative to these three indices have gone down from close to 60% in 2016 to just above 40%, a nearly 50% decline in our active managers, how active they truly are. Now, one would initially think that this is simply a function of there being less opportunity to be active, in a market where the amount of listings have similarly declined. But this is in fact not the case. In reality, because work that we've done shows that alpha opportunity has actually increased in recent years. Now, this means that the payoff to being active and correct is higher today than it was 10 years ago. So it's not that there's not opportunities, but rather, that active managers are perhaps positioning themselves more defensively when it comes to active share. Now, if we keep in mind how assets tend to track performance in South Africa, as I showed you, past performance is a good indicator of where flows go, then it should be less of a surprise to see managers being loath to stand out, opting instead to track benchmark indices more closely. In fact, going to that 40% level that we can regard as quasi-index tracking. Now, this would, of course, not be a problem in and of itself. In fact, we strongly advocate for the benefit of accepting market prices as being efficient and tracking indices then directly. The only problem is that active managers are much less active today, but are not giving investors a rebate for being less active, right? And so you pay for active, but get something more akin to quasi-tracking today with managers on aggregate. And you can see how this can be a problem. And in fact, to see this in action, the next slide shows us the spread between top performers and bottom performers. And so unsurprisingly, the result of active managers being less active today is that the spread between, call it rock stars and managers that are in the doldrums have actually declined in recent years following that decline in active share. And so this has shrunk considerably for equities, this spread, but even more so for balanced funds. So on the next slide, I show you the balanced fund spread in the high equity category as well. Now, what's interesting about the graph that you see on this slide is the closeness of the spread between top and bottom performers in the multi-asset space. Now, compare this to equity funds only, where actively managed asset strategies have even more ability to differentiate themselves, right? both through asset class allocations as well as deviating tactically within asset class. So there's more opportunity to be active. Yet we see the result of inactivity playing out on this graph, where there's this narrowing of the spread between top and bottom performers. Now, the reality is that managers, while preserving the ability to be active in this space, find it risky to do so in a market that often rewards performance far more so than process. So I'd rather not be in the bottom quartile, not stand out, and rather be comparatively quasi-index tracking and not take too much risk. Now, this picture gets even more interesting if we look on the next slide. So this applies to low equity multi-asset strategies as well, where the difference between top and bottom performers have become oddly narrow, considering the opportunity for differentiation also in this space. And so the question then is, well, if you're paying for an actively managed strategy in the low equity multi-asset space, then perhaps interrogate how active the managers truly are. Now, the fourth question that we posed on the next slide was whether vanilla index trackers alternatives offer value above that of just being a purely cost-saving exercise. Now, interestingly, the first thing that I want to point out, so what we show here is a distribution of the ranking of the capped Swix relative to active peers. So in other words, every month of the past 20 years, we look back 3 years, and then we calculate a percentile ranking of performance for all the active managers. And then we slot in where the capped Swix would have ranked. And so what you'd assume to be the case is if I flick through once, you'll see that the distribution, we would assume the distribution to be at the 50th percentile, right? Because that's, if you logically think about it, if it's a commonly accepted benchmark, then you'd think, well, some managers are overweight, some managers are underweight. And so the distribution of percentile ranking should be sort of close to the 50th percentile rank. You wouldn't expect it to be consistently above. But in fact, what we see is that index returns have a distribution that's closer to the 65th percentile, if we consider it on a 3-year or rolling percentile rank, with median outperformance more than 3/4 of the time, 70% of the time, 75% of the time, you're outperforming the median active manager. And this is the thing that we need to ask why this is the case. Now, there's 3 key reasons we want to put forward for this. The first is, of course, cost. And with active managers being less active today than in the past, it simply compounds the problem of recouping higher costs through successful active management, because it becomes harder to do so consistently, particularly if we think of consistency and what I showed you earlier in terms of timing of execution. It really becomes a hard task to actually recoup the additional costs. Now, there's also, to this point, the adage that in finance, you get what you don't pay for. So higher fees definitely compounds against active managers trying to outperform lower cost alternatives and certainly will make their lives more difficult. Now, another reason that's seldomly considered when it comes to index tracking is that index trackers mostly, if not always, avoid the red zone, that deep underperformance, in other words, bottom quintile performance. Index trackers avoid that red zone almost entirely. And this is no fluke. In fact, we believe this is by design. Now, we analyzed the performance of index trackers compared to active managers using their relevant benchmarks for several global universes, in fact, including France, Spain, Italy, the US, UK, etc., Australia, and more. And the results very consistently show that an index that's relevant to the active managers that are tracking it, right? So, in other words, if we take the SA General Equity category and then the benchmark that's relevant to those active managers, what you find is that benchmark almost always avoids the red zone, irrespective of geography, where you are in the world. Now, this follows as managers generally are spread between being over and underweight index constituents. They are cognizant of the benchmark, meaning it is a low-cost reflection of positions in the active market itself, without the cost drag involved. And so thinking of index investing this way means that you gain from lower costs, yes, but you also get more consistent outperformance relative to active peers, and also, crucially, you avoid being the worst quintile performer. And so this lack of deep underperformance simply means it compounds in investors' favor over time. So it's a cost compounding, but it's also a performance compounding. Now, all of this combines to show you on the next slide a compelling case for an investment alternative being index tracking. So in this graph, we show the three different local equity index alternatives on a rolling 3-year performance compared to the median active manager through time. So you want to be below that dotted line, which means that the index is outperforming the median active manager. Now, this shows us that index trackers net of a very conservative layer of fees of 50 basis points consistently outperform active managers over time. Now, with regulations having been relaxed as to how much active managers may allocate offshore, the Katzke, in fact, saw a period of underperformance when global markets rallied and the rand weakened. Now, we can see that by comparing the Katzke to managers with the majority of their assets held locally during that period of where the Katzke underperformed relative to median managers. We actually see that if we look at the managers that held most of their assets locally, that the Katzke outperformed those managers. So again, it's a very compelling case from a performance perspective as well as a cost perspective. And so, again, I can bore you for another hour, Ruan, on the virtues of using non-vanilla index strategies as well, which includes thematic indices in our factor range, which also offer similarly low cost, but more efficient and bespoke designs that offer clients investable alternatives that you may consider as part of a well-diversified portfolio. I can speak to that, but in truth, even just looking at vanilla indices, suffice it to say, I think it makes a very strong case for having indexation, be it vanilla or non-vanilla, as part of your portfolio.
Yeah, thanks, Nico. Those are awesome insights. And one retort we often find when discussing the cost saving and performance enhancement of index strategies is that increased levels of indexation introduces inefficiencies. And it seems perfectly logical to say that if index tracking increases, this will necessarily increase price momentum and create an exploitable distortion and fuel bubbles. We've analyzed this in the local market and actually found that index trackers create no clear arbitrage opportunities through buying or selling opportunities, albeit in a market where indexation is still a small slice of the pie. Now, what's interesting is that Goldman Sachs last year wrote a report where they studied the impact that increased indexation has had on stock prices within the US, where we know more than 50% of assets managed in that country follow some form of rules-based approach, be it vanilla market cap weighted strategies like the S&P 500 or a non-vanilla factor or thematic index. So interestingly, they found no evidence of indexation causing any of these assumed distortions, and it didn't fuel bubbles or price correlations either. They simply find no evidence of this. And I think this speaks to the fact that not all assets need to be put to use for price discovery. It could plausibly be that you have an efficient market where a smaller segment is geared towards price discovery and that flows are reflective more on capturing asset class exposures than taking advantage of price distortions. So some really interesting insights. We've linked the paper there. Please reach out if you want us to forward that on to you.
Thank you very much, gents. So Kingsley, considering how the market is realizing the value of adding index funds to their portfolios, both from a cost and a performance perspective, is there a good argument to be made for blending together index trackers in a multi-asset portfolio? If I bring it closer to home, how has the Satrix balanced index fund performed, and how consistent has it been in delivering value to clients?
Thanks, Ruan. I'm definitely going to answer all those questions. But before I provide an update on our balanced funds, I'd like to remind clients of our philosophy in constructing multi-asset portfolios. And it may seem a little bit at odds with what the rest of the industry sells and purports to be able to do. So backed by numerous peer-reviewed studies and empirical research, the policy benchmark or strategic asset allocation of a fund is by far going to be the primary determinant of your long-term returns, far more than any other source. And it's for this reason that we stick to a thoroughly researched and regularly reviewed SAA, or strategic asset allocation. You'll often hear it's not timing markets, but time in the market that is the most important factor for achieving investment success. Yet, many managers charge higher fees to do the exact opposite, claiming to switch between different asset classes and be in or out of equities at different times. We stay true and consistent to the maximum of time in the market, and this is the way in which we manage our balanced funds. We find that very few managers and their funds are able to consistently exploit tactical asset allocation opportunities for their clients' benefit on a net of fees basis. Furthermore, backed by rigorous research, factors or styles have been shown to be the primary driver of active returns, which we exploit within our domestic equity strategy. Again, we do this sensibly and cost effectively so that the benefit accrues to our clients. We steer clear of stock picking and market timing, where Nico showed that the odds are severely stacked against managers being able to consistently add value, especially with a higher fee hurdle that they need to overcome. Now, while overall flows on this next slide into high equity multi-asset funds were back in negative territory in 2024, and you'll see that with the red shaded area of the multi-asset high equity category, we see that investors are now allocating to lower cost index balanced funds, and that's shown by the yellow line being above the zero. This represents rolling 12-month net flows. And this has been a consistent trend of new flows being allocated to rules-based balanced funds since they were launched over 10 years ago. Whereas traditional actively managed balanced funds, as a collective cohort, promising alpha through tactical asset allocation in exchange for a higher fee, have been suffering outflows. And you can see that by the cyan or light blue line being below the zero axis. Now, if we look at the performance of the Satrix Balanced Index Fund specifically, we can see it has delivered exceptional returns, illustrating the value added by focusing our efforts on the medium to longer term strategic asset allocation decisions, while using low-cost index tracking building blocks to construct a well-diversified fund. We have compared the performance of our fund in dark blue to the performance of an equal-weighted blend of the largest 10 actively managed balanced funds. And despite the outflows from these funds, they still dominate the total AUM of the high equity multi-asset category and are therefore a proxy for what most clients have experienced within their portfolios. For completeness, we've also shown the peer group median, which over most periods, the largest 10 active blend has managed to outperform. However, we believe this is a poor and uninvestable benchmark, and even more so if performance fees are based on it, especially when you consider what our Satrix Balanced Index Fund, tracking a multi-asset benchmark, has achieved in comparison. Now, while looking at realized period performance at a point in time is necessary, certainly as a first-level observation, second-level analysis is more insightful to show the consistency with which we achieved this performance. So in this chart, you'll see the percentage of time that our fund has been in key percentiles relative to all other funds in the category. Over all rolling 3-year periods and longer, you'll see the percentage of time that our fund has outperformed the median is in excess of 90%. So that's all the cyan and blue shaded segments in the middle bar. It is also a top quartile performer, which is shown in the 2 shades of blue at the top, in excess of 59% of the time over rolling 3-year periods and almost 70% of the time over rolling 5-year periods. Now, 5 years is generally the minimum investment period for a moderate aggressive balanced fund. This should give you a great deal of confidence when allocating to the Satrix Balanced Index Fund when investing for the medium to long term, such as your retirement. Context is important and critical, and over rolling 5-year periods since the inception of the Satrix Balanced Index Fund, where most assets have been invested in actively managed balanced funds, top quartile performance has been achieved less than half the time amongst the equally weighted blend of those top 10 funds, top 10 actively managed balanced funds, meaning more time underperforming the median, as you can see in the chart, or delivering average performance near the median with the light blue cyan color. We have to ask our clients whether doing the same thing is likely to deliver different results. Another way of looking at the consistency of our fund is to plot a distribution of its percentile ranking. Our median percentile ranking is at the 78th percentile, using rolling 36 or 3-year percentile returns or returns. And importantly, we are never in the bottom quartile on a rolling 3-year basis, similar to what Nico showed earlier, which means clients have peace of mind. They aren't missing out or regretting being invested in a fund that has deeply underperformed. Over the last 5 years, using those rolling 3-year returns, in other words, looking at 8 years' worth of data, the Satrix Balanced Index Fund has been the 15th most consistent performer in its category, and that's out of 144 funds. That is top decile consistency for you right there. Now, if the previous chart was a little bit difficult to understand, this turns it sideways, so we can see the rolling 3-year performance as a percentage rank through time. Here you can clearly see how consistently the fund is above the median, as well as being in the top quartile, while never giving up these gains by being in the bottom quartile. The Satrix Balanced Index Fund has been one of the most consistent funds over the last 10 years, as measured by the average rolling 3-year performance rank relative to peers. In fact, only 6 funds had a more consistent return, which speaks to the value of focusing on the long term while keeping running costs as low as possible. You see this in the lack of consistency for more expensive funds, as well as the lack of correlation between fund size and consistency. Now, the way we achieve this is by considering the risk, the correlation, and various return scenarios when determining our strategic asset allocation. And this chart shows how our strategic asset allocation has changed through time. Now, we will continue to review our SAA every second year through a rigorous process with the aim of improving our offering further. It doesn't mean we will change it every 2 years, but the possibility to do so is there, and it is one of the key benefits that clients receive by investing in Satrix balanced funds. Our last review of the SAA occurred in 2024 and was implemented in September, where the big decision was to increase our exposure to fixed income bonds in preference to inflation-linked bonds. Our research has shown that on a strategic basis, clients are better rewarded by holding nominal bonds, with ILBs only providing short-term relief during inflation surprises. Since we don't tactically allocate, this creates a drag on overall performance. The other big change was to remove local listed property as a separate allocation in preference for more broadly diversified listed property globally. This fund still has exposure to local listed property through the SA equity allocation, but the timing to remove this local listed property was opportune given the strong rally that we experienced and saw since our previous SAA review in 2022. Now, a key question which arises out of this process is whether reviewing our SAA and the changes we've made through time have added value. So, Nico, I'll hand over to you to take us through that.
Yeah, so as you can see on this slide, what we show you here is just our strategic weight column, and then the returns over just a few different periods, just to give you a sense of how these asset classes have performed. Now, the first thing to take note of is actually how strong bonds have done over time, specifically compared to, for example, the Katzke, the local equity universe. Bonds have delivered quite a fair bit of value, and we know this to be the case locally. Another interesting feature and something that's vindicated our past views on this as well is our 0% strategic weight to global bonds, so the Bloomberg Global Aggregate. What you see there is that global bonds have not delivered at all, irrespective of what time frame you're looking at. It's been perennially underperforming. And in fact, a few years ago, when we did our SAA, we actually reasoned that it's become an uninvestable asset class, global bonds, simply due to the low yield, as well as the comparatively high duration risk that remains. So you're just not getting good bang for buck. Global equity has done phenomenally well, and we continue we've slightly increased our exposure there, and that's something that we want to keep in this portfolio. And then important as well, as Kingsley mentioned, those real assets for us, infrastructure and property, great balance, risk balance in our portfolio, as well as providing that yield that we're not getting through global ag. So yeah, we truly believe that this strategic weight that we're currently positioning will stack the odds in investors' favor. And to what we've been saying now, because we're accessing those asset classes through low-cost, highly efficient index tracking vehicles, we really believe it puts the odds in our investors' favor.
Thanks, Nico. So if we turn our attention now to the Satrix Low Equity Balanced Index Fund, we conduct the same rigorous process to review its strategic asset allocation every second year. The idea with this fund is to provide a more stable return with a lower real return expectation than our Satrix Balanced Index Fund. And the benefit of that is that that should be realized over a shorter investment horizon, typically a minimum of 3 years. The direction of the changes in the low equity index balanced fund are similar to the Satrix Balanced Index Fund, with nominal bonds being upweighted and inflation-linked bonds being removed from the strategic asset allocation for the same reasons that I mentioned before. Now, over the last 12 months, if we look at performance, we're also delighted with how this fund is behaving, with the ranking of our fund firmly in the top quartile. Over all periods, our fund is ahead of the median, and over the last 5 years, also ahead of the largest 10 funds in this category by quite some margin. Now, if we do the same analysis and look at the consistency of the performance of this fund since its inception, it may not appear as compelling as our Satrix Balanced Index Fund. And while still avoiding the dreaded bottom 20% of performers, the Satrix Low Equity Balanced Index Fund spent too much time in the third quartile. Now, we were aware of this back in 2018 and 2019 and implemented some changes in 2020 after carefully evaluating what the primary drivers of performance were in this category and whether we were optimally capturing them. So post those changes from 2020 onwards, which involved enhancing our cash return further and gaining more exposure to higher yielding instruments in the short duration income space, we're pleased to see that this fund is now behaving very similarly to our Satrix Balanced Index Fund. And you can see that with the yellow or the gold shaded bars, now with a median percentile ranking at the 70th percentile. The result of the improvements can clearly be seen through time in this chart, where the marked step up into the first and second quartiles is evident from 2020 and 2021 onwards. So, Nico, over to you.
Yeah, and I think it's so interesting, Kingsley. If you canvass, I suppose if you canvass the market and ask them Satrix Balance Fund, they'd think it's a 60-40 split between equities and bonds, and we don't really apply our minds in terms of the construction. I hope it's clear after this session how far that is removed from reality. Simply looking at the performance of this strategy and how consistently we've delivered above median and even quartile top decile performance, it certainly shows that there's a lot going on under the surface. So 2024, again, as Kingsley mentioned, saw us again do our asset allocation review that we can put on this slide and show you. And this review takes us quite a long time. We put a lot of effort in this, specifically because our thesis is that the value that we add through our balance funds is by focusing on the long term, keeping our eyes on the horizon and not sort of being swayed by noise in the short term. So getting our strategic asset allocation call right is everything for us, because we don't in the interim tactically maneuver in order to add value to this portfolio. Now, the review that we did last year, again, involves us working very closely with a diverse team of active managers, analysts, economists, and the like, to determine a bottom-up valuation for the different asset classes that we want to invest in. And then after that, we do a range of quantitative tests on it, test various different combinations, ultimately to produce an optimal portfolio that we believe will deliver value for the medium to long term. Irrespective of the economic conditions that might apply in the future, we believe this is the best current exposure that we can offer our clients. Now, our thorough asset class review is done, like Kingsley mentioned, every 2 years or whenever there's some significant regulatory changes that might prompt us to bring this forward. Now, last year, our consensus view was to increase our nominal bond exposures to 20% in our high equity balance fund and 45% for the low equity. Now, in our view, local nominal bonds remain one of the most attractive sources of yield over the medium term for local investors. particularly compared to other sources of yield. If you think ILBs and SA property, which offer lower expected yields and high duration risk, respectively, local nominal bonds stand out for us there. We also believe it is a very opportune time to increase our exposure to local nominals, particularly as the high yield, we believe, is structural. And what I mean by this is global demand for local bonds have come down dramatically over time. And there's various reasons for this. Some of this include our junk bond status and grey listing, which simply means that global investors are not able to invest in South African bonds despite the very high yields that we've seen. Now, should these factors improve, we could very well see strong bond inflows as well from global investors looking to take advantage of these high real yields. Now, this would simply translate into strong capital appreciation on top of already very high real yields that you're earning. So in other words, the worst case of not these sanctions not being lifted means you're still earning a very high real yield. The best case is, like I mentioned, high capital appreciation and continued strong performance in our local bond market. So we're very bullish on local bonds there. We also, as before, prefer real asset exposure in the form of global property and global infrastructure above the low yield and duration risk that is at play with global fixed income. With the Trump administration coming in, there's always this tension between fiscal expansion, inflationary pressures, and the Fed has very clearly shown their hand in terms of a willingness to act when it comes to raising rates to curb inflation. So there remains a duration risk for global bonds, and we don't believe you're fairly rewarded for taking on that risk. So this real asset exposure served us well in the past, and we believe that it offers a good source of yield as well as equity-like returns. So we really like that. Lastly, we are slightly overweight EM, which serves as both a DM equity diversifier, as well as we're seeing quite a fair bit of upside for China and India in particular to reap the rewards of their improved standing in tech and high-end production processes. So we believe EM, it's the time for EM to deliver. It feels like everyone says that every year, but truly we believe there's an opportunity for specifically those Asian economies to come to the fore and really deliver. So this is our positioning.
Thank you very much, gents. Kingsley, 2024 was also a busy year for you in terms of product launches. I want to end off this conversation by asking if you can maybe just summarize all those changes that happened to our product set over the course of last year. Kingsley?
Sorry, Ruan. Very happy to respond to that. The culture at Satrix is to constantly look for opportunities to add value to our clients' investment journey and make sure we're always at the forefront of what we offer. 2024 was no different, with a number of projects and initiatives within our product lineup coming to fruition. So firstly, we structured our NASDAQ 100 ETF to directly track the NASDAQ 100 index, and this actually took effect in January of this year, 2025, and passes on greater cost efficiency as well as deeper liquidity to our clients. A huge congratulations needs to go to the project team involved, as this is now our first global ETF which directly tracks its underlying index rather than via a feeder structure. Now, another significant change was the reduction in fees for clients on LISP platforms who were using and utilizing our Satrix MSCI World Index Fund Unit Trust. This is the only MSCI World tracking fund in South Africa that I'm aware of, priced in rands, that directly tracks the MSCI World Index, which means clients no longer have a lag in performance between the fund and the index. It also takes advantage of dividend withholding tax benefits, which results in further performance improvements, all at a lower fee, which means more returns for clients. We have had great support from the market for this fund, especially post the change. So a heartfelt thank you to all of our existing and new clients who are invested in this product. And then thirdly, we pioneered the first global balanced ETF to be listed on the JSE. providing a great entry point for investors wanting to diversify globally, but who may not be sure where to start or who don't want the volatility associated with an equity-only strategy. Now, this is available at a 35 basis points total expense ratio. So the fee would be even lower than that. For 35 basis points at a total expense ratio, you can get globally diversified exposure. And that's because it's an ETF, that's the price for all clients, whether you're retail, or accessing it through a platform. And so this makes it the most cost-effective global balanced fund available in the market. Nico, I'll hand over to you to take us through some of the other changes.
Yep, so I'll be very brief with that. We also listed the Satrix Low Volatility ETF, which offers risk-conscious investors a low-risk alternative to the capped Swix, while preserving a high beta to the capped Swix, in fact. So, in other words, the idea is we aim to preserve upside while limiting the downside. That's really what we're trying to achieve with this index, where you preserve the beta downside. That's where you want to not participate in. We also listed the JSE Global Equity Index, which, despite its name, might be confusing, but the ideas or the purpose of this index is for it to be a local equity index that upweights inward listed stocks, such as Richmond, Anheuser-Busch, Prosus, and others. Now, effectively, this provides investors exposure comparable to the Aussie of old, right? Where currently, with the indices having harmonized, and we've spoke ad nauseum about this, the opportunity is there for us to provide an index that upweights the inward listed stocks. So in other words, you get the higher exposure to global companies, and so you get a better rand hedge through this index than you would otherwise utilizing other local indices. Now, lastly, we also launched the MSCI World Islamic ETF, which offers clients a low-cost access point in an otherwise quite expensive segment in our market. So the Sharia-type funds generally operate at quite an expensive segment. So we believe this low-cost offering will serve our clients' interests as well.
Thanks, Nico. And Ruan, before I just hand back to you, 2025 is going to include further new additions and enhancements to our range. So to all of our clients, please make sure you are connected to our communications so you receive our updates as soon as they're announced. And Ruan, if I may volunteer your email address or you and your team's contact details to any of our clients who might be looking for a strategy that they can't find, please reach out to us. We'd love to hear from you, and we'll certainly consider any additions to our suite as based on there being sufficient demand. So back to you, Ruan.
Thank you very much, Kingsley. And thank you to you, Nico, as well. I think that's all the time that we have for today. I want to thank everyone that has joined us online. We know that your time is valuable, and we hope that our discussions today have given you greater insights into our market trends and the value that indexation can add to your client portfolios. Please reach out to us for more information on any of our capabilities, or if you have any questions that we were not able to answer today. Have a wonderful day further. And from us,